Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really happy everybody could join us today. We are here to try to help you improve your retirement, at least in a financial sense. We look at retirement planning. We're going to talk about Social Security maximization today. We're going to be, talking about how to manage the assets, what's happening with the markets. And so you can send in questions. We will answer those, try to answer those live here on the show. Ask Tom at talkmoneywithtom.com is the email address if you want to do an email, or you can just put it in the chat here on the channel. We'll try to capture those. Also, you can send in those emails during the week. And some of the questions that we'll cover today actually came up during client strategy sessions that maybe others want to hear the answer to also. So, and then of course, we have this channel. We've got a lot of different videos on here. If you want to subscribe to the channel, then you can hit the little bell button right next to it. And it'll basically give you an update every time we put something new on the channel. And then, of course, if you want to, you can just meet with us. If you have some questions specifically, there's a book appointment button up in the corner of our website. Link for our website is here on the channel. You click that button, pick a 30-minute time to meet with Ethan and I, and we'll, discuss whatever it is that you need to discuss. And so, looking forward to today's show. We really try hard to provide some content, that will help people in the retirement, whether they're, heading into retirement, or they're already in retirement. A lot of these things apply to both groups. So hopefully we can get something from that. I do like to start off the show each week with a summary of kind of what I saw happening in the stock market this week. And again, this is the 6th week in a row. It's kind of fun doing the show when it's up week after week. And there's a couple things that are happening that are quite, important in my opinion. First of all, we have, October 13th was the low point in 2022. So we just had our 2-year anniversary. So we'll talk about the significance of that. And, what we talk about is the primary direction. So the primary direction is still up, that's for sure. And then the other thing that I think is quite interesting also, just looking back for the past 12 months, October 27th was the low of last year. Well, not the low of last year per se, but that big drop that happened during the summer. And we've had quite a nice run. We had a 5% drop in April, 8.5% drop in August, I think a 6% drop in September, all of which recovered very quickly. You can see those. I would call those V recoveries, right? Yeah. Instead of that kind of long recovery that we call U recovery. V recoveries are a sign of a very strong market. It takes a week or 2 or 3 to come all the way back to, whatever it is that was lost. Most of the downturns in the last 12 months have come around concerns about slowing in the economy, mainly the job market, because we saw unemployment pick up a little bit and those types of things. And that has, continued to get a little better, probably within reason as far as that goes. And we're seeing more and more reports that are coming out showing that the economy is maybe pretty far away from a recession.
Yeah,
right?
It might be slowing down, but it's still a strong economy.
Yeah, I mean, this week, for example, yesterday, market was up during the day. We had some good reports, earning reports from Netflix, from Taiwan Semiconductor, which we can talk about semiconductors because that's been a big area right now too. But and so the market's up in the morning, and then all of a sudden they come out with the retail sales report, which is quite good, better than expected. And the market actually ended up down, 0.02%, but it came down.
Yeah, I think it's more that the market's reevaluating the amount of federal tax or how much the Federal Reserve is going to actually cut interest rates.
Yeah,
and I think every time we get another strong report, they're like, okay, maybe we're only going to get one hike or one cut, or like it's only going to be 2 quarter cuts. So they're changing their scenarios based on that.
Yeah, because after the last meeting, the September meeting, I think of September 18th, the Fed, cut half a point, and the market was expecting, I think, a 56% chance of another half-point rate cut here on November 7th, which is coming up. And now that's disappeared. There's no expectation on the futures market for a 50-point rate cut. It is still in the low 90 percentile bet that there will be one rate cut. And be quarter point in that case is what they call one rate cut. Now, I think the thing that's interesting, though, the numbers keep coming out kind of stronger and stronger. I bet you there's going to be an awful lot of debate about whether they should even do one. I know the market is expecting at this point that they do one. But we've seen, unemployment claims get a little better, retail sales. And so we'll see, we're going to get the PCE inflation report that'll come out at the end of the month that they'll be able to see. Of course, we'll get
I think they might get one more jobs report.
one more jobs report just before, right?
Yeah.
That sounds right. And so, the last jobs report was a lot higher than expected,
And they revised up previous months that were quite low too.
Yeah, exactly. So, if they get another good jobs report along with all these other things, do they not cut rates? Now, long term, I don't think this stuff makes that much difference. That's what I was saying yesterday in the daily video, was just that although the market dropped, based on this good retail sales number where good news is bad news, I said ultimately good news in this case, I think, is still good news because a recession is what we're used to damaging the market. The 2008 downturn and the 2000 downturn, 45% down and 57% down. Those were caused by recessions. And so I think, having a high retail sales is a good thing. It pushes recession farther off.
Yeah, and even other investment banks also think this. Goldman Sachs trading arm, Scott Rubner, their bank managing director of global marketing and tactical expert, he expects the benchmark or the S&P to end above 6,000 for the end of the year. Historically, from October 15th to the December 31st, has been a 0.17% return.
Average return.
Average return, and then in election years, the median return has been above 7%.
No, that's interesting. So a little over 5 in a normal October 15th to end of year period, and it's a good time of the year. It just has been always. I always look forward to it. It's holidays.
It's median, not average, actually.
Oh, median. Okay, and then that jumps up to 7+% in an election year. That kind of jives with my experience, going through these things. It's a pretty good time to be an investor right now. There are things going pretty well. And so, when the retail sales report comes out and it's positive and the market drops, eventually the market's going to catch on and start to move. And it already is today. We're sitting at an all-time high. If it happens to close there, we'll hit another one. I think that'll be the 46th one this year. And I don't know what much more you can ask for. And this week, one of the things that we did see was quite a heavy rotation into, again, other areas outside of the Magnificent Seven.
We saw like a lot of flows based on just earning reports.
Yeah.
Financial earnings were good, so we saw a lot flowing into the banking industry.
Yes, yeah.
If a player like ASML, which is kind of like they provide the manufacturing for companies that actually do the chip manufacturing, the lasers. They had a bad report, and you could see how the industry reacted poorly to that. Yeah,
there was a pretty big sell-off early in the week in the semiconductor arena because of this ASML, earnings report. And then, Thursday, Taiwan Semiconductor came out, and they're obviously a major player in the semiconductor arena. They had a very good report. They had a very good outlook.
And you could see like Nvidia and AMD and the other semiconductors bounce from that.
They all came back pretty strongly. Nvidia had hit, I think, on Thursday a record high, maybe it was Wednesday, a record high itself, and then got knocked down with that ASML report. So, we're in the middle of earnings season, so and it's very important. Earnings are the main driver for the stock market, so it's kind of interesting to see. But you don't get, high earnings from every area. The reason that they're concerned with ASML, it's possibly a leading indicator for, what if these companies are stopping or cutting back on buying these lasers, then maybe they're cutting, having the slowdowns, in the front end.
Yeah,
also.
And the industry also had kind of some regulation concerns too,
Yes.
With the Biden administration possibly doing export limits on certain AI chips to
certain countries, basically.
It's mainly directed at China, but they also want to cover other countries to prevent, basically selling to another country and then China importing from that country. So it was a broad amount of countries, I think 40 plus, that was actually thought to be on this list.
I think these import restrictions they're tough to enforce just because, there's enough bad actors out there that can funnel things around. I mean, you've read a lot of articles about, the restrictions on Russian oil And, Russian oil is still kind of getting out there in different ways. I would imagine Russia's not getting as much as they would have gotten without the restrictions in terms of, dollar per barrel. But I think the part of the reason we're seeing oil sitting in the $70 range, is just because, there isn't a massive shortage of it. Partly maybe because Russian oil is coming out. So you have to wonder with the chips. Yeah, but every time that gets announced, hey, you can't sell to China, or now it's, China and other countries. And it's further restrictions is basically what they were talking about this week. That takes a chunk out of the semiconductor market.
Yeah,
for a little
it takes
while.
out, it hurts their revenue, and then that hurts their profitability and earnings, and so it kind of is like whatever, any restriction slows them down.
And my gut feel is that, especially with Nvidia, you read their earnings reports and you look at what they're doing. I mean, they're already, inundated with orders. I would think that, cutting back some orders could be damaging long term, but right now they've got enough customers that'll buy what they've got. They can't keep up anyway.
Yeah.
So, because the foundries like the Taiwan Semiconductor that are making, some of these chips, it takes time. If there's a massive explosion in demand, you've got these very large machines, and very expensive machines.
It takes time.
Right?
You can see with Intel, who's been struggling because their foundry is taking more money and more time than expected to get up and running.
Yeah, there's a surprise. So let's talk about some of the history of these running markets like this. So this is what's called a bull market. So bull market means the market is going up, the primary direction is up. A bear market, the market's going down, right? So let's look at the history of the bull market. So this came out, there we go. This came out, again, this is a little bit hard to see, apologize, but you can look at the little blue bars there. This is every bull market going back to 1949, okay? And so you look right now, we just hit 2-year anniversary. And there, if we go back a ways here, 1966, there was a 2-year, run. 1970 was a 2-year run. That was during that high inflationary time period, much higher than what we have now. No pandemic, to push things with, the high retail sales, I still think is somewhat related to this kind of, pent up demand that's still coming out of this, pandemic and the money that people have. But you've got a 12.3 year run in 1987 to 2000, 11-year run from 2009 to 2020. And so one thing to keep in mind is that the average bull market or up market is 5.5 years in this time frame. So we're at 2 years. Again, there are some that stopped in 2 years, so it's possible, but the average is there, 5.5. And then the average rate of return during that 5-year period is roughly 180%, and we are at 60%, give or take, right? So there's some room potentially on an average basis to continue this run. And I think it's super important to kind of understand that. Now, also one thing I think is fascinating is that over a period of time here, they've been able to use things like quantitative easing, the interest rate reductions down to zero, and we've been able to shorten some of these, recessions in terms of at least time, especially starting in 2008, because a lot of this stuff came at the bottom of that market that we're using now. And so the Treasury and the Federal Reserve have these tools that they really haven't used before, and those tools can allow the market to continue running. Personally, I think there's some danger in those tools, right? Because we're kind of flooding the market, to be able to make this happen, the number of dollars getting printed and those types of things. However, as long as we can sell our treasury bonds, which we have been able to do quite nicely, and we can especially sell them during times of stress. I think this is super important to understand. When you're going to do these fiscal stimulus things, you're going to send money out to people's households, you're going to, do quantitative easing and buying bonds, like the Federal Reserve does on the open market. You have to be able to finance that through the sale of bonds. And the times that we would need to do this the most are the times where things are really falling apart.
And that's when investors tend to run scared or have fears, and they run to treasuries.
And they run to the U.S. So I've said for a while that, if you look at, first of all, looking since the pandemic, the U.S. has had the greatest recovery out of the pandemic. China is struggling. They had all kinds of issues with how they handled the pandemic to a certain degree. And so they're still kind of behind. I think they eventually emerge from that and do quite well. but it's going to, there's a lag there. I mentioned before, I'm really glad that lag was there, because if China was hot like the U.S. is hot, we'd still have an inflationary issue, I believe. I think China is struggling a little bit here, and they're actually having a deflationary issue in the country itself. Kind of keeps things going, and then maybe when the rest of the developed world starts to slow down, China starts catching its legs, and they kind of keep us out of a recession. So that's something that I've been looking at for quite a while. But when you look at kind of what's going on in these markets, I don't see anything that says to me at this point in time that this bull market can't continue, right? And so anything can happen. I've mentioned before, we didn't expect the pandemic. As a matter of fact, if you go back and look at the chart prior to the pandemic, matter of fact, here it is. We had a big drop. If you look, that first drop, that big drop that's on the chart here, on my side, that was a 20% drop at the end of 2018. And that had to do with the raising tariffs, and at the same time, the Federal Reserve was raising rates, which is not a good combo. And the market didn't like that. They cut back on the threats of raising tariffs a little bit, and then the Federal Reserve actually started cutting rates, and the market took off. And we were on a really nice path up until the pandemic with that big cliff, right? Yeah. So here you are, bull market. What was the length of that bull market in the end? It was 2018.
It was 2009.
That was part of that 2009. Okay, yeah, that's right. They didn't actually get the full 20%. I think it was like 19 point something percent. So they don't consider that. That's how you stop a bull market, is drop 20%
from the high
to the low. And I do believe that they didn't consider that a full bear market, so kept it going. But we were in the middle of a nice recovery out of that, and the pandemic. And so anything can happen as far as that goes. Keep that in mind. But I still think that there's some good factors here. So one of the things that came up in one of my strategy sessions, a client asked me, well, market's doing great, but what could keep it going, right? So a couple weeks ago, we discussed a report coming out of UBS about basically what they saw as the potential for another roaring 20s, right? Where we have this kind of big run up. And these are the 4 mega trends that they saw, which I'll present again because I still think they're important. If you can remember these 4 when you're thinking about the market, especially if it's suffering a little and coming down 5 or 10%, think about these mega trends, because this will help. Again, our object here is the positive, trying to weigh more evenly with the negative that we all get. So capital spending boom could occur. So one of the things that happened 2020 caused a big capital spending boom, as people were all getting settled in their homes and all this stuff. And so what it did, it kind of consolidated, and we're now, almost 5 years away from that. It consolidated a bunch of capital that was, purchased, is now 5 years old. And that tends to be an arena where you start to see that, replacement of that.
Especially as, rates come down and people are more willing to spend their capital.
Yeah, that's exactly right. And so that's why rates are so important as far as that goes. And, some of that capital spending is coming in this newish concept of artificial intelligence. We've seen, announcements from, I remember Microsoft was about a couple months ago announced they're going to build a data center with $100 billion that they're spending on that, right? So there are some pieces there. The enormous investment for green energy, right? So one of the things that we realized during the pandemic was that you need to be more self-sufficient.
Yeah,
right?
Insulated from other countries.
Yeah, and you look at what happened with Russia and Ukraine. Europe looks at that and says, hey, we need to be more self-sufficient. And it isn't just trends that would happen here in the U.S. It can happen anywhere and flood that world with money as far as that goes. And of course, deglobalization, which is what I'm talking about with clean energy, isn't just energy. It's semiconductors. It is onshoring different manufacturing that has been shipped overseas for 20, 30 years, is now starting to come back. And that takes a big capital expenditure to do that. And I think it's super important, in terms of the level of types of jobs that you can have, the, security. if we can actually get to a spot where we're making, have some capability of making our own semiconductors, that would be, I think, a really big deal, because we've got, I think we have exposure as a world, certainly as a country, having all that done. Now, I read an article saying there's basically 22 steps to, completing a semiconductor, give or take. And because semiconductors are so light, they don't have to be in one place. They can ship them really easily and move them around. And so here in the US, what we're working on with Intel, for example, is still only like 4 or 5 of those steps.
Yeah.
So they're still going to make these things in Intel here in the US and ship them, across the ocean and then back again. And so, and again, during the pandemic, we realized that doesn't work very well, right? That movement was difficult. So, we might not ever have another pandemic, but it is still coming on. And of course, the last one is artificial intelligence. And we talked about, this big data center and those types of things. So I do think this is important. I think this is the types of things that can drive the market. If we look at the typical anatomy, right, of a bubble type market, which is what we almost always end up with in the end, you will have kind of these big companies move first because they're safe. So the Magnificent Seven are known for that, because they have great cash flow, huge cash positions, dominant markets, right? And then it starts to spread. And so we're seeing a spread right now. We're seeing real estate and utilities and financials and small caps. And, we're starting to see a bubbling up of some of these other things. So that's normal. That would be part of the anatomy. And then I would expect an IPO market to start taking off, because there's been a long time since we've had a good IPO market. And so maybe next year, second half of the year or whatever, we start to see there's a lot of companies probably sitting out there waiting.
Yeah, and so this IPO market will be good at first, because it'll be all the companies that have been holding off on their IPOs.
Yeah.
But eventually the market will get kind of inundated with IPOs. And
Right.
so a bubble is when you have things that shouldn't be IPOing or shouldn't be coming to the market and pushed up, but they're seen by the market as good.
Yeah, exactly right. So that that's the end of that piece there, is when you start to see the craziness. When you see bingo.com.
Yeah, it will be like AI or .ai next.
Yes, exactly. It will be, and it'll be and it'll be if you look at what was happening at the end of the big run in 2008, anybody that could fog a mirror was getting getting a house. Negatively more amortized loans were, I remember reading an article, it was over 80% of homes selling here in the area were selling with negatively amortized loans. So basically, you pay the minimum payment and the value of your loan was still growing. You weren't paying enough to make the full payment, but you could qualify for that minimum. More people could. And of course, all of that exploded on us. So those are the types of crazy things that you'll see at the end of these bubbles. But we're like solidly at the end of the first third or something along those lines, at least in my opinion. Now, oftentimes that you can see some slowdown in the actual rates of return. Like the third year tends to be not nearly as good as the first 2 years. Sometimes the fifth year can be that big blow off top. We had 1998. I think the Nasdaq doubled that year in that particular run. And so, it's fun to watch, but at the moment we don't have any of those things, right? Again, if you look at the anatomy of what's happening, if you look at the major factors, that are pushing things, things aren't too bad actually. So, and the market concurs with that. We're seeing, new all-time highs on, at least a weekly basis here as far as that goes. So. The record is 77 all-time highs. Somebody asked me that. Now I'm kind of locked in on it.
It's gonna be tough, though.
It'll be a tough one to get to, but I don't know. I'm voting for it. So anyway, that's something to watch for. But thank you for joining us. For this summary. I like to do this each week, so look forward to doing it again next week, and we will be here. So let's start with our first questions.
So. This question comes up a lot. When should I take Social Security? And honestly, it's a very unique answer for everybody.
Yeah, it's actually when to take Social Security is probably one of the more controversial subjects that come up, in our business. Which probably denotes how exciting our business can be. But nonetheless, it is a hot subject. And I think one of the problems that people have is that they may be right for their situation, but they may be wrong for somebody else's situation.
Yeah,
right?
there's no, one answer fits everybody's situation.
Yeah, and I have some, we prepared this because we got asked this question by a client. So there's no perfect answers. All right. This is really important to understand that, we're going to show you some case histories here, and you can see why there's different answers based on the different
And the thing
situations.
is, the reason there's no perfect answer is because you can't tell me you're going to live to 80, 84, and 89 days.
Yeah.
There's no definitive time that you're going to pass away.
Yeah.
And so we're trying to run this to figure out what's a good situation based on your factor.
Yeah, you can start Social Security at 62. So if you don't start it at 62, then you could have taken the money. And so theoretically, you start later, you get more, which is great. But in order to kind of make up what you didn't take, you have to live to a certain age to make that work. And none of us know if we're going to make it to that age.
Yeah.
If we get to that age, now we're at break even. So we're, it would be the same. If I took it at 67 or 62, I've now broken even on that at some point in my life. And everything past that, I'm making more money than if I would have taken it at 62. Same thing for 67 versus 70, however you want to look at it. And so longevity has a big piece of it. It is, to me, what do you want to plan for?
Yeah,
a short life or a long life?
Yeah, there's a lot of factors that actually go into it. So that's why it makes it so unique for each person.
Right, exactly right. Okay, so let's take a look at some of those factors. Age and health. And we've had literal situations where people have told us, they don't expect to be here because of some disease, that they have. And so, I've only heard that a few times. Most of the times where, the rest of us are in the dark as to what's going to happen there. But that's an issue, What's your family history like?
Yeah,
right?
If you have your grandparents that live to their mid 90s, and you have that kind of longevity in your family, you're more likely to be kind of similar, especially with the advancement of medical.
Right, exactly. Work status, so, are you still working or not? They take some of the Social Security back between your full retirement age, which is for most people now is 67, and 62, so you can make a certain amount, what is it, around 20,000 right now that you can make without having any impact to your Social Security. You don't lose it, you get it back later. It's still a benefit to work, but it's a little interesting. Now, then are you single, divorced, or married? Because that has to
I also forgot to put on one of those. Are you widowed or not?
Oh yeah, widowed, exactly. So those are all factors that fit into when you should take Social Security. What's the benefit amount? What's the benefit amount for each of you? If there's more than one of you, that matters. Non-covered job, right?
Yeah, are you going to have any kind of stipulation because you have a pension that you'll have a less of a benefit?
Yeah, and then need. So 58% of Americans take Social Security at age 62, right? And if you look at the other factor there, that the average 65-year-old in America has $49,000, Social Security is basically something that isn't really an option to wait because it can't pay the bills. Maybe they lost a job or got laid off, and don't have the wherewithal to support themselves, and so Social Security starts, right? So those are factors. I'll put one other factor in there that what's your outlook on Social Security? Because one of the things that happens is some people take Social Security because they think it's going to go out of business.
Yeah, and that's been a feeling for a long time, and I don't expect a reduction in benefits. Maybe they'll reduce, how much the COLA goes up, or there'll be other reductions to the younger generations that are funding Social Security. But I don't feel as a retiree that's getting Social Security or nearing Social Security age, there will be any kind of significant changes for you.
No, I used to, before the pandemic, attend a class about Medicare and Social Security, and we used to talk about that all the time. And one of the things that came up one time was somebody found a Time cover of a Time magazine from 1941 that Social Security was going to go out of business. So this has been going on for a really long time. I've had people tell me I'm taking it at 62 because I want to get what I can get while I can get it. Personally, I wouldn't put that in one of my factors because Social Security is way too important. When the overall average population doesn't have any money, this program is critical. Now, I agree with you. They're going to reduce benefits for, I mean, my father's full retirement age was 65, mine's 67. Maybe my kids or something else, right?
Maybe mine's closer to 70.
Right, exactly. So that's going to happen. But in terms of it disappearing or affecting you, so if you're 62 right now and you're worried about it going out of business, I wouldn't.
Yeah, because but the government understands that you make your decisions and you invest on these factors,
right?
And so you can't make a quick adjustment to a benefit change like that. So you need multiple years, a decade or so to like.
Yeah, just to be clear, if you take it at 62, they actually reduce your benefit by 35%.
Yep.
And so if you go the other way, if you wait till full retirement age, your benefit will grow by 35% versus taking it at 62. It's not really, but that's how it works. But then after full retirement age, let's say 67, it grows at 8% a year. Plus, you get the cost of living increases too. So that's a really good rate of return. And then you have this bigger dollar amount at age 68, 70, whatever it is. And now any cost of living increases are on a bigger dollar amount, and it can really roll forward. Okay, so some of the risks. You die early, right? And you didn't take it early, so you missed out on taking
potential
some of that.
benefits, basically.
Yeah, exactly. So you died before your break-even date, basically. And we'll show you what that means. Or you live long, and you took it at 62 or whatever before full retirement age.
Or you took it at 67 versus you live.
Or 70. Yeah, 70, exactly right. You took it earlier than 70 in the end. You're going to have a smaller benefit, right? And again, personally, I look at that, and I personally would be looking at the living long, only because my experience as a financial planner, the most difficult thing to do is to make your money last long time. So if you retire at 65 and live to 95, that's 30 years.
Yeah.
If you die at 75, it's not a good scenario, but financially, it's a lot easier to get through that 10 years than it is to 30.
The bigger risk for a financial planner is you're planning for longevity. That's the one we're more scared of.
It's what we work on all the time, is just some assumption, because again, we've seen it literally. I remember a 93-year-old calling me up, taking out the last money out of his IRA, and he's like, Tom, I lived too long, and he didn't live too long. He just didn't have the money established to make it work all the way through that time frame. And so maximizing Social Security can help in that scenario as far as that goes. Okay, so let's go through a base case here. We got John and Jane, and again, some of the small print here, but everything's the same. They're the same age, right? They have the same benefit, 2,500. How old are they?
61.
61, perfect. Okay, so they're looking at, okay, next year I'm going to be 62. Should I be taking Social Security or not?
Yeah, and again, this is just in a vacuum. It's not looking at your financial plan, your assets outside of the Social Security. So it's a very kind of, it's just a case study. It doesn't really live up to like a full person's life.
Yeah, for us personally, we like to do these Social Security analysis inside of a financial plan, where we have everything else. We have all the outflows, we have all the inflows, we have all the assets, we got how they're invested, we got all the tax situations, Roth, non-Roth, 401k, all of that. And then you can kind of really organize how you should do Social Security. And so this is a Social Security analyzer, as you mentioned, in a vacuum. So that's a good point, but still useful to look at. And it's amazing to me how many people make choices on Social Security without going through the full process of figuring out what really works for them.
The one thing is, with Social Security, you're taking a snapshot, and you really can't go back.
Right.
You have like 12 months, I believe, and then you have to pay back all the benefits, which is a kind of a painful process in that itself.
Yeah.
If you want to kind of reverse and take a benefit later.
Yeah, that would be brutal. So then just a couple of assumptions. Cost of living increase is going to go up 2%, and we're picking average life expectancy out of this program, male 84, females 87, right? So those are in there. And so then it spits out these scenarios, and you can look at kind of the bottom line, lifetime benefit. So both of you take it at John and Jane both take it at 62. They get, if they live to those ages, they're going to get $1.3 million, right? You look at both of you taking in number 2 here. John claims later at 70, and Jane claims early. So she takes it at 62.
And he takes it at 70.
And he takes it at 70. They get $1.5 million. So that's better than taking it at 62. Again, if they both live to those ages. Let's say they both take it at 67. That's even a little better. Not a lot better.
Yeah.
I might, if I had to choose between 2 and 3, it's about $20,000.
I'd probably go for 2.
I'll probably go for 2. Why not? Let Jane take it early, take some pressure off, that type of thing. So, but number 4 is just the opposite,
Jane's at 67.
Right.
And then John's at 70.
Yeah, so not taking it at 62, but she's taking it at 67. That's bigger. That's $1.6 million. That's starting to get to be big enough that you might think about that one over 2 or 3. And then the maximum benefit, again, living to those ages, is age 70 for withdrawal on both of them, which is $1.6 million and a bit more than the number 4. So, it's run thousands of scenarios to kind of come up with these.
It usually runs on each month. It kind of because every month that you don't take Social Security, you get a little bit more.
Yeah, that's important to note that, the 8% is 0.75% a month. And so every month, past full retirement age, when you get that 8% growth, even if you just wait for a couple of months, you're going to get a 0.75% every month on your benefit. That's still worthwhile if you can. All right, so let's take a look at a different scenario. Now this one, we've got an age difference.
Yeah,
and
John's 51 and Jane is 61. So it's a 10-year age difference.
10-year age difference. And so what happens then? What are the maximums? And again, I won't go through all of these. We'll just look at, it's right above my head here, so I'm sorry I'm in the way. But the maximum benefit payout is if Jane takes it at 70, right? And John takes it at 65 in this case. So different than the last one. The last one said 70 for both.
And it's a bit unusual because it's 65, which is usually you think about 62, 67,
right,
and then or 70 is kind of.
And again, it's running thousands of scenarios, and this is the one that maximizes it for them, assuming they live to these ages.
Yeah,
right?
84 and 87.
Right, and so that's $1.8 million. Okay, again, part of the reason that's higher than the last slide is because somebody's living longer. John's 10 years younger. So it's not so much important to compare one scenario to another. It's important to compare all of these 6 scenarios, right? So that you can see which one's the best. And maybe something that's really close that you still think is, worthwhile. It is kind of interesting. Look, you actually get less if you both wait till 70 there, number 5, right?
Yeah.
Again, the reason that everybody's having arguments over when to take Social Security is because it's different for each person as to when, in each situation, in each couple, whatever it is, when to take Social Security. Okay, so one more kind of run through here, another scenario. Now, here's where there's the same age. They're both 61, but they just have a benefit difference.
Yeah.
And so John, go ahead.
John's $2,500 a month, while Jane is only $1,000. So you start to qualify for spousal benefits.
So we did the first one; everything was the same. Second one, difference in age. Third one here is just a difference in benefit, right? And so again, if you look at number 5, maximum benefit is Jane takes it at 67, John takes it at 70, and that's the best, total return. Again, living to 84, 87. We haven't changed that as far as that goes. Now, again, there are other options we can choose. We can choose short lifespan and try, if somebody says, I don't know if I'm going to live that long, we can try the short lifespans and come up with the optimal, scenario for withdrawal. If they've got, I have a client that all 4 parents, lived over 100 years old, the only one I've had, but you got to think, wow, there's some longevity potentially in that couple, right? So maybe we'd even go longer. You can choose.
Yeah, you can put a custom age in there.
Yeah, you can choose. In that case, 100 if you wanted to see what the maximum benefit would be as far as that goes. So that's, again, there's no one answer that works perfectly for everybody.
Yeah, I think this is something that you should sit down and take your time with. It's not a decision to take lightly or take just over a weekend. I think it needs a little time and research. And it's always good to go to, if you're a financial advisor, and be like, hey, I'm thinking about Social Security. How can we maximize it?
Yeah, that's right. Because we can run this program for people, and then we can also run, the maximizer inside of our financial plan. We use Money Guide Pro for that, and we can kind of see, what that is. And you have to, if you're going to delay it, you have to be able to. So that last factor of need is pretty important.
Mm-hmm.
Most of our clients are our clients because they do have some resources and they have the potential, not all, but they have the potential to wait on it if they need to. And so then you want to see, you know, that's where the financial plan, running it inside the financial plan makes sense, because what's happening here with this particular program is that looking at it without looking at your other assets.
Yeah, what's your opportunity cost?
Yeah, and so what are you withdrawing from while you're waiting?
Mm-hmm.
How much impact does that have? You might get a different answer.
Yeah.
Depending, you got everything in taxable accounts, you got everything in tax deferred accounts, you know, whatever that might be. There's different scenarios that play out. You know, what rate of return are you getting on your other assets that you'd be withdrawing from in order to let your Social Security continue to grow? And so maybe it makes sense in those cases if you have a really good rate of return and you think that that might continue. There's one other scenario we didn't cover here too, but it's also possible, and that is where you take it early and keep the money and just invest it,
Mm-hmm.
right? And so the weird thing about that is that we've never seen anybody do it. And lots of people talk about it, and I'm sure somebody has, and I'm sure somebody that's watching this will. I'm just telling you, with what, 6,000 financial plans?
It's a rarity.
Yeah, it's a zero so far. But nonetheless, what that does do, it is interesting. It depends on what rate of return you're expecting to get on that money. And so if you put a real high expectation, then
yeah, you could possibly beat out the.
You can beat it out, and basically, what happens is it makes your break-even age older, because now you've got this money. So the comparison of take at 62 and invest versus take at 67 or 70, because I've invested this, now my break-even moves out.
It could, especially even if your your return is slightly below the rate that Social Security increases.
Yeah, I think if you put in a 6% rate of return, it works pretty well, and I don't have any problem with any of these scenarios. I don't have an axe to grind. We don't get paid more if you take it at 70 or 60. I don't have any, bias on it. What we're just trying to do is make sure that you don't run out of money. Mm-hmm. Period. That is the goal. And so what's the best scenario in order to make sure that somebody doesn't run out of money? And so, again, if somebody approached me and wanted to do the investment part, I'd be more than happy to try to make that work. It's nothing wrong with it. I think, again, you do need to kind of accommodate your own, feelings as far as what you feel about what might be happening too. Look at the numbers, and then kind of factor in your own thought process as far as that goes. All right, so that was a pretty good day today. Really excited to be able to dig into the Social Security. We've been getting a lot of questions about it, both in client reviews. People have been asking us to do more. We have 2 videos. Maybe we can link them in the comments or something when we put this out. On Social Security, I think they're our most watched videos and most commented videos. A lot of, kind of harsh comments, of course, because it's a controversial subject. Don't get us wrong. We're not advocating. If the numbers say you should take it at 70, that's what the numbers say. That's the way it is. If they say you should take it at 65, okay. I just want to have a concept of how to maximize the situation, and we can test anything. I mean, literally anything, any ages, any returns. We can test any scenario and see how it works out and try to find the optimal scenario, and maybe even the optimal scenario within the realm of what you're really interested in trying to do, right? So anyway, that's what's happening. Glad everybody could kind of join us today. I think these subjects are super important, and I believe personally, Social Security is a really important, vehicle altogether. And, we get these young kids that we do plans for, and they're like, oh, don't even count Social Security. Well, you talk to somebody who's already retired, they realize how important it is. Yeah, it's a really nice cash flow, especially when the markets are going up and down, which they do. Okay, good. Well, thank you very much for joining us today. Again, you can send in questions. Today's subject about Social Security came from questions that were sent in. Ask Tom, talkmoneywithtom.com. And we'll be happy to look into that and work on some answers and such too. Obviously, we created this channel in order to be able to, create a resource that people can use and learn about, retirement. These aren't things that are taught in school very often. So, subscribe to the channel, hit the bell button, get notified, when we put new content out. And of course, you can just meet with us if you'd like to. Ethan and I are available. Schedule's a little tight here at the end of the year usually because we've got a lot of year-end stuff going on. But look forward to being able to talk to you if you'd like. There's a book appointment button on our website right up in the corner. It looks just like that. Our schedule's there, and you can pick a half-hour time that works. And look forward to seeing you again next week. Thank you very much.